Investors see bonds as a safe investment, but recently we've seen that the bond market can cause pain. Ray Martin is a MoneyWatch.com special contributor and financial advisor. He's here to explain what all of this means to you. Ray, thanks for being here.
Hey, great to be here, Jack.
So let's start with the real long-term view. Bonds have been on a terrific rally for 30 years. Back in 1982, yields were sky high, and basically they've been trending downward, making existing bonds all the more valuable. And they even hit a low of about 2.5%, even below that recently. But then there's been all this turmoil in the last few weeks. Can you explain what's going on?
Yeah, there has, and you're absolutely right. Bonds have had a better return than stocks over the last 10 years, clearly giving people false confidence. But here's what's going on now. The yield on the all-important 10-year U.S. Treasury has gone from 2.4% up to about 3.45%, a 40% or 43% increase in yield. That translates over the last 3 months to almost a 5% drop in value on a risk-free 10-year U.S. Treasury. That's pain. People are losing money in what they thought were safe investments.
Right, risk-free, right?
Right.
So how does that translate to your portfolio? Because most of our viewers probably don't actually own the 10-year, but they own mutual funds or ETFs that have the 10-year. What are they seeing?
Well, check this out. One of the largest taxable bond funds in the country, the PIMCO Total Return Bond Fund, saw a loss of about 2% in November alone and continued losses in December. And for the first time in 2 years, that fund has clocked net redemptions for the month of November. And so investors are now fleeing bonds and selling some of their bond funds. That PIMCO Total Return Bond Fund is a proxy for that. The manager of that bond fund, Bill Gross, the bond king, who always speaks his book, has said bonds have probably seen their best days. Those are behind us. And he thinks returns on stocks may be better over the next year.
I hope the rally or the bear market doesn't go for 30 years.
Right.
The ETF that tracks the broad bond index has been ugly too, I think down 7%. And we should explain that with stocks, especially after a 50% drop a couple of years ago, these don't sound like big numbers. But for bonds, these are ginormous. I mean, these are what you get in a year, not in 3 weeks.
That's correct.
What should investors do? How can you protect yourself?
Well, I think people have to brace themselves for the fact that it's very likely that the best return, we have historically low yields and historically high prices on bonds, and you have to believe in a reversion to the mean. So you've got to believe that you're going to see more losses in the bond market, particularly in long-term bonds. So here's what you do. Here's a checklist. If you own bond funds, make sure the funds you own have a duration of 4 or 5 years or less. That's a measure of how short-term the bonds are owned in the bond fund and how much it could lose over a period of time if interest rates rise.
So they're looking for bonds that say short-term bond fund, basically.
Exactly.
Okay.
And that measure of duration, you can look it up on Morningstar and sites like that, our site as well, of 4 years or less. Look for bond funds that focus on emerging market bonds, bond funds that focus on floating rate bonds, bonds that adjust as rates go up, they actually pay higher interest rates, bonds that have inflation-linked bonds issued by foreign governments. If you look at those categories, they should actually hold up much better here, and actually as rising rates factor into them, they should even increase in value over time as well. So that's a good playbook for your bond portfolio. If you own individual bonds, hold on to them as they roll off in maturity, and then just look at the bond market here.
And we should point out that this is not Armageddon. For all you and I know, bond yields will go down, the market will rally again. We don't know what's happening. It's just an important gut check to realize that all that money has flowed into bond funds for 2 years. Right. Now suddenly those people who bought as it was moving up are selling as it's going down, and you need to remain diversified, prepared for whatever scenario happens.
Yeah, don't freak out and sell all your bond funds. Look at the kind of categories I talked about, or see your financial advisor about different types of bond funds that you're going to need to short-term and some of the other categories we mentioned here on this segment. And you're going to need to mix it up a little bit here and be careful when you're investing any new money here, and you might want to wait it out a little bit.
But you'll be prepared for anything if you follow your advice, right?
That's right.
Thanks, Ray.
You're welcome, Jack.
And thank you for watching.